What's happening, investors? AK from Fallible here. Today we're going to talk about how you can make big money on earnings announcements. Yeah, we're going to talk about PEAD. And that's P-E-A-D, not P-E-E-D. Like who P-E-E'd all over this floor, and why is your aim so bad when you literally have so much room for error in this giant urinal? What is wrong with you? Is your junk broken? P-E-A-D is an acronym that stands for post-earnings announcement drift, which basically means that stocks tend to drift in the direction of their earnings surprise for an extended period of time. Now, PEAD is considered a market anomaly. They call it an anomaly because of the efficient market hypothesis, which states that markets can't be beat because share prices reflect all relevant information all the time. This hypothesis, which for short we'll call EMH because we obviously need more acronyms in this video, is complete bullshit. And if you believe it, then you're an idiot. But I know none of you believe it, because then why would you be watching this channel trying to up your trading game, right? It wouldn't make sense. But just in case you do believe it, well, by the end of this video, you'll understand why our fallible investors peed all over EMH. Yeah, it's another juvenile pee joke. I don't know. I'm not that creative. Sorry. Anyway, in future videos, we'll cover EMH in more detail and debunk it even further. And then all of us can trash that ridiculous hypothesis and the academics that push it down in the comments. It'll be fun! So make sure you subscribe to this channel and hit that bell so you get a notification when that video is released. Okay, now let's get back to PEAD. So the first step to profit from this strategy is to scan for earnings surprises. If you're fancy and got a program that'll do that for you, then great. But if you don't, that's no problem, because you could do it the old-fashioned way with a site like Zack's earnings or something similar. Once you have a list of stocks that have beat earnings, then you gotta scan them again to see which ones had a significant jump in price. See, you can't just look for an earnings beat, because that's not enough. You need a jump in price too, because that's the signal that the investors that are actually putting their money into the stock were surprised as well, not just the analysts. And as these investors reevaluate the company, you'll see them invest more money into the stock. And then they'll tell their friends who will jump in too, and then you got guys like us who are scanning for this stuff and we jump in as well. And before you know it, you got a trend on your hands. Now, normally what happens is that the first earnings surprise is followed by more good news and more good earnings. It's not just a one-time thing, because whatever structural change happened in the company should continue to benefit it. So you'll see the same process over and over again. Investors get surprised and then they bid up the stock price. Now, there's a particular group of stocks this strategy works best on, and we're about to cover them next, so make sure you keep watching. Okay, so if you really want to get all that PEAD that you can, just get a bunch of PEAD all over your bottom line. Yeah, I still can't think of any other jokes. Then you gotta look for the earnings surprises and price jumps in thinly traded stocks that have little to no analyst coverage. You're gonna get the biggest trends and the most amount of runway with these guys. Maybe it's a company that no one has heard of. It's been building a long base, maybe months or even years, but then it releases a product that turns out to be a hit. The product shows up in the next earnings report strong with really good numbers that surprise everyone. And then the stock shoots out of its base. And that's the point where you wanna get in. Over time, the stock is gonna get more and more popular and more investors will come to invest. But just like with any stock, eventually the PEAD wears off because investors' expectations catch up with the company. It becomes popular and everyone starts tracking it, so it becomes a lot tougher for the company to exceed expectations. And when that happens, you're not gonna have as strong of a trend. And that's why if you want the most benefit, then you gotta get in when the stock is under the radar. And then you ride it up until it becomes a popular growth momentum name. A recent example of PEAD in effect is Etsy. Back in February, their earnings per share beat estimates by over 300%. The next day, price jumped over 20%, breaking out of that small base. If you bought then, even after that huge jump, you would have still been up almost 30% right now. Earnings are coming out again next Tuesday, and we'll probably see the company beat expectations again, and the trend higher will probably continue. One of the websites I really like, called StockBee, has a blog post that goes into all of this a lot more in depth. They even give you some inputs that you could copy and paste into your scans to help you find these plays. I'll link to StockBee's article in the comments, so make sure you check them out. Do you have any scans that you use to track plays like this? Let us know in the comments. And if you haven't already, make sure you subscribe to this channel and hit that bell for notifications of new videos. I'll talk to you again soon. Bye.